Hello, and welcome to Mayor Brown's podcast, Credibly Challenged. This podcast focuses on risk management issues for financial institutions of all sizes, particularly those in the banking sector. My name is Matt Bisanz, and I'm a partner in Mayor Brown's Financial Services Regulatory and Enforcement Practice. Joining me today is a special guest, Bill Hulse from the US Chamber of Commerce. We're going to have a little different episode than we usually do today because, as you can hear, Bill does not come from a financial institution. In fact, he doesn't even come from a financial trade association. Instead, he is a senior vice president at one of the largest trade associations in the country, covering all types of entities out there from the commercial sector through to the financial sector. You'll hear more in a couple minutes why Bill is on this program and why he has an interest in bank risk management. But thanks, Bill, for being on.
Matt, thanks for having me on. Happy to be here.
So the big issue today that we're going to be talking about is banking policy, mainly around capital policy. That a few weeks ago, Bill and I were at a roundtable on the Basel III Endgame proposal that I think you've been hearing a lot of news about. And we were talking about why a commercial organization like the US Chamber of Commerce is so focused on banking policy right now. Bill, could you give me a few thoughts on why this has become an issue for your group?
Right. So businesses of all sizes depend on the U.S. banking system for everything from a small loan to treasury management services to accessing the capital markets. This is a major rule that will have a macroeconomic impact. In fact, the U.S. Chamber released a report just last week on how businesses view financial challenges, Basel III and beyond, where we survey about 300 corporate treasurers and how they view the financial system and their ability to access capital. We survey small, medium, and large businesses on this, and while small businesses and large businesses sometimes have slightly different views on financial regulation, they all agree it impacts their bottom line. So in general, 87% of U.S. businesses reported negative effects from financial regulatory related cost increases. In other words, they see a cost passed down to them when there's a financial regulation imposed on their bank or their asset manager or insurance company. 40% have reduced certain types of services to customers in response to financial regulations. And over 1/3 of businesses are raising costs due to regulations imposed on the financial sector, causing operational constraints that impact their ability to provide services and invest. Now, this is just another way of saying inflation, which has also been on people's minds in DC and across the real economy now in recent years. And regarding the Basel proposal that we're talking about today, Matt, we actually asked some pretty specific questions and got some pretty specific feedback. So 68% of respondents believe that a proposed net increase in capital requirements under Basel III would be damaging to their businesses. And this is especially heightened for SMEs. And 77% of businesses are concerned that investment grade private companies will be treated less favorably than investment grade public companies. And finally, 53% of businesses believe that the costs related to swaps could make it more difficult to manage risk. So, as you pointed out, this is a banking issue, but it is much more than that. This is really a business issue and a Main Street issue.
Yeah, I think it's interesting that when we look back at that paradigmatic movie, It's a Wonderful Life, where we look at the two banks that were in the city. There was the Bailey Brothers Savings and Loan, and then there was the evil commercial bank that was trying to steal it. Really, at the time, those two banks, or those two models of a savings association and a commercial bank, their main customers were mortgages for home mortgages like George Biddle's mortgage, and small businesses like the Main Street economy in that little town. And even going back to when I was a child in the 80s, that you still saw things like mortgage that were completely dominated by banks. And I would imagine it was in many ways similar for the many small businesses among your membership. Today, though, as regulations like the 2013 Basel capital increases have come out and other regulations out there, like how the Volcker Rule raised swap prices, how Title VII raised swap prices, I think we've seen a pretty big transition of those sectors away from banks, where now banks make the minority of residential mortgages, and even things like small business credit is coming more and more from the non-bank sector. So I guess that even though no one can say, oh, well, it's gone down, there are fewer mortgages being made, it certainly can shift around the financial ecosystem based on the weight of regulation. Um, were these particular proposals that came out in July what you were expecting?
So I think I'll say on your last point, at the chamber, we believe in kind of the 31 flavors of capital. We believe banks play an important role. We believe non-banks play an important role. But I do think it's fair to say that we've seen an increase in the amount of non-bank activity in this space, and capital requirements and other regulations imposed on banks, certainly might be the cause of that and should be part of the conversation. In terms of what came out at the end of July, so the Basel III proposal came out at the end of July, and I think to some degree yes, and to some degree no. It's not what we were expecting. I want to start with saying that we believe the Basel Committee is an important interlocutory body. Standard setting serves a valuable role to avoid market fragmentation and any regulatory race to the bottom, and the Basel Committee does a lot of great work. U.S. regulations, however, should be fit for purpose in U.S. markets and adhere to U.S. law. And the standards developed by the Basel Committee are just that, standards. They're not a treaty. So our primary surprise is the rules are far from capital neutral. Jerome Powell, Randy Quarles, and other regulators had stated for years that the amount of capital in the banking system is about right. Our second surprise is that the rules at minimum undermine and potentially violate the letter of the tailoring requirements out of the Economic Growth Act in 2018. Third, we were pretty shocked that U.S. regulators would again gold plate, as in go above and beyond and internationally agreed to minimums for capital requirements, which can disadvantage banks operating here in the U.S. And then finally, we have quite a few process concerns with how U.S. banking regulators have gone about implementing the Basel III Endgame standard.
I think it's interesting. I know you're going to get into more detail on it in a little bit later, but when you talk about the undermining the spirit of tailoring, that certainly is true. That under tailoring, there were the different categories of banks that were established based on their size and complexity, and each of them had different layers of regulation. So that obviously the most systemically important, the US G-SIBs, had the most regulation, and then your smaller, say, $150 billion consumer bank had the least enhanced regulation. They all had an enhanced level, but the smaller ones had the least enhancements. And what I thought was really interesting about the proposal is it even goes further in the other direction, that for something like market risk, it says, even if you're a small regional bank who has effectively no market risk or no market risk, you still have to build the system to calculate market risk capital requirements as if you had a material amount of market risk. And so it's almost like the opposite of saying, not only are we going to untailor the rules, we're actually going to say that people need to comply with rules that shouldn't even apply to them. So it's almost going in the opposite direction. And I think that one, at least for me, was a real head scratcher. But you're the one who's been engaging more with the market on this. So what has been your biggest concern, either that you've been hearing or that you've come up with?
So on your last point, that's exactly right. There seems, I keep hearing this talking point of, oh, well, these regional banks, if they don't have a significant amount of market risk, they're not engaged in the swaps market, for example, that they're not going to have to hold more capital. And that may be true, but from a regulatory compliance perspective, you're exactly right. They're going to have to do the modeling. They're going to have to come up with the internal frameworks and governance to ensure that they are remaining compliant with these regulations. And that has material costs around it as well. And so I think one of the things you and I were talking about the other day, too, is just, how we talk about capital and resolution in the United States, and whether or not, the proposal that came out in July was in some ways a reaction to some of the instability in the banking system earlier this year, or overreaction, and how that's coloring the debate in Washington. And, there's been a lot of comments from Governor Barr and a lot of speeches saying that he's very concerned about those market events. I think we're all very concerned about those market events, but there has been little work done to connect those market events to the capital proposal that came out in July. And I think there's been different views and thinking too about just how severe those events were. And what you and I were talking about the other day is really need to revisit the conversation about what bank resolution in this country looks like. Large companies in the US fail all the time. And this is part of the risk taking that is inherent in our capitalist system. WeWork filed for bankruptcy just last week, Bed Bath & Beyond earlier this summer, household names. Would we panic if Caterpillar, which has over 100,000 US employees, announced bankruptcy next week? I certainly understand these examples are apples to oranges given the business model of banks and the role of the public sector in their stability. But there seems to be an increasing belief that banks are more important than these other types of companies. The first big part of the conversation should be about if we are comfortable as a country allowing a large bank to fail. And there seems to be this belief that all large bank failures create financial contagion or that banks cannot be resolved in a way to limit financial stability risks. And that's just not the case. The resolution and sale of First Republic Bank, for example, which had over $200 billion in assets, is recent evidence that large banks can be resolved in a relatively orderly manner. Certainly, there was a lot of questions around that bank. But in this case, there was no systemic risk exception invoked and all depositors were protected.
Yeah, and I think it's interesting that even when there is a systemic risk exception invoked, like for the other two banks that failed, it's much different than bankruptcy. That when a corporation goes into bankruptcy and goes before the bankruptcy judge and it has all of its debts listed and all of its assets and it goes into liquidation, let's say, that the creditors who maybe get pennies on the dollar, dimes on the dollar, they take a loss for the amount that they don't get. That if there's fewer assets than liabilities, everyone gets back maybe 60 cents on the dollar, and that's 40 cents of loss that is borne by the private creditors. That the bankruptcy court doesn't bear it, the government doesn't bear it, even the industry that the bankrupt company is in doesn't bear it. But banking's a bit different. That when the FDIC comes in and closes a bank in the normal course, if there is a loss to the deposit insurance fund, in normal times, it would be made up through assessments over time on the other banks in the system. So just every quarter, banks pay an assessment for their deposit insurance, and that accumulates in a fund managed by the FDIC. I think there's about $100-ish billion in there right now. And yes, the FDIC has recourse to the Treasury, et cetera, but really that deposit insurance fund that's funded by the industry is the main tool. And then, like I was saying, for the systemic risk exception, that the FDIC is required to put special assessments on the industry. And so the FDIC is just finalized, I think, some assessments on the industry to make up for the losses caused by those two banks earlier this year. So in this case, it's one of the odd things of not only did depositors get all of their money back, but the losses the losses that those depositors would have borne shifted over to the private sector in a way that would never be the case in a corporate bankruptcy.
Yeah, that's right. And so kind of begs the question then, why is the Federal Reserve proposing such a dramatic increase in capital? And there's kind of this question around what is the risk of getting it wrong, and can you have too much capital in the banking system?
Yeah. Well, what do you think about that? Could you have too much capital? I mean, isn't more always better?
So if you overregulate, you risk putting banks out of business. Again, apples or oranges, but if you were to require a company like Caterpillar to sideline significantly more cash, what would that mean for their ability to compete in the marketplace? The global capital markets are highly competitive. It will not be easy or inexpensive for banks to raise the capital required under the Basel III rules. They'll be competing with each other and competing with all the other companies that are seeking capital in our markets, all of their competitors and peers and other companies that might have a good return on equity. So banks will ultimately be able to raise the capital, but at what cost? Will they significantly reduce lending to other parts of the economy that maybe aren't as profitable, or will they raise costs on their customers to regain some of these costs? It's one or the other. By no means am I suggesting arguing against capital in the banking system, but there should be an understanding that the principle of diminishing returns is applicable here.
Mhm.
All policymakers should be striving towards the optimal level of capital, not just more capital for more capital's sake.
So I think a lot of us here, like you said, are familiar with lending and the potential effects of capital regulation on lending because the two are so intrinsically tied. But maybe thinking about some of your policy concerns around some of the other less frequently discussed risks, and let's start maybe with market risk that they are expected to be some of the most significant increases under the proposal in absolute, I guess, in percentage terms. And market risk, at least I've been doing this over 10 years, and it almost never comes up because it's that kind of thing that those big banks do with some really smart mathematicians inside. And so even a lawyer like me doesn't see a whole lot of market risk. But can you tell me a little bit about how that market risk trickles down to your commercial members?
Absolutely. So the market risk capital requirements go up by a staggering maybe 70%. Certainly depends on the bank and their activity, but for most banks active in the capital markets, it's material, extremely. So just a few examples of kind of the things that our member companies are concerned about and we're educating them about. So think of what this means, for example, for corporate bond market liquidity. If you have fewer banks buying and selling corporate debt, you'll have less liquidity, and the market's going to price in a premium. Um, that premium ends up being borne by the issuers of that debt. Whoever is holding those securities is going to demand a slightly higher yield. We're also thinking about this a lot in terms of what it means for hedging instruments, so futures and options markets. Kind of outside even just the corporate context, there are 50,000 farmers in the United States that use hedging instruments, according to the US Department of Agriculture. So they're using these instruments to hedge for all sorts of different events. What's it mean if the livestock that they plan to bring to market next year isn't as strong as they expected? Or what if there's some sort of weather event? What if there's some sort of geopolitical risk, for example? There are, multiple wars raging in the world right now, and what's the effect of the war in Ukraine on the grain markets? Like there are just so many examples here that companies are really hedging around just in the agricultural space. And if these instruments are more expensive for them to use or they're less available, they're going to be less likely to hedge or they're going to have to pay more for them. So that's a real cost. You could also talk about the examples too for like interest rate swaps. This is more in the financial space to companies that are exposed to interest rate risk. But if you're a large life insurance company, you have a lot of interest rate risk, and the availability of interest rate swaps is going to be important to you. Or even just think if you're an airline or like a regional trucking company, you need to hedge the price of gas. So you're looking at crude oil futures. Again, material to the business. This is one of their primary inputs. And if they can't have some stability and expecting what their costs are going to be next year, either putting some sort of like floor or ceiling around that, how can you plan as a business? These examples go on and on, but they really are material.
I see a physical therapist, and she was saying that she and her fiance have to move from their apartment complex because the rent went up $300 a month. I'm sure that that apartment landlord isn't happy about having to raise the rent. It's one of those large corporate-owned properties, and if they had an interest rate swap in place on that mortgage, maybe they wouldn't have had to raise it so much on her and lost her as a good tenant.
Yeah, absolutely. I mean, that is a great example of how this isn't just a business issue, but also there are plenty of businesses that they aren't renting an apartment, but maybe they're renting a floor of a building or they're renting out some sort of warehouse. These costs are going to go up if they
Yeah,
can't hedge it, or their landlord's not hedging it. Someone needs to pay for the difference.
yeah, there is no free lunch. One of the harder risks, I think, to conceptualize for many is this new one around operational risk, which I've often said is the risk of something bad happening, be it a bank branch burning down or an ATM network being hacked, that those are all of the kind of things that are operational risks. But maybe you could tell us about your concerns with putting capital requirements on that.
You're right. This is an entirely new capital requirement, and I think that's made it a little bit difficult, at least thus far, for people to envision how to implement it and what exactly it's supposed to do. So the incentives here seem pretty odd. It requires a bank to hold capital against challenges they expect in upcoming revenue or expenses, either a drop in revenue or some sort of expenses, instead of making investments to prevent them in the future. So, if you had some sort of losses related to, as you said, your ATMs in the last 10 years, you have a sense of what those might be going forward, and there's a multiplier against that, and then the bank is required to hold that much capital. Better yet, it would seem, would be to take that cash and invest it into fixing the ATM network so you don't have those expenses going forward. Much better to just not realize new expenses instead of just expecting them and paying them out. But this capital requirement is especially punitive on products that are more reliant on fee income. And this is a good reminder that banks do more than offer credit products that generate interest income. So there's kind of quite a few examples in this space, but one example is, a small business credit card. It's just, the operational risk requirements are especially punitive to unused lines of credit. Banks will likely either have to decrease these credit limits or maybe add on some other fees to recoup these costs. They're pretty punitive to capital markets activity. So think of a company that wants to IPO. There's no interest income there. The bank needs to do the underwriting, it needs to do the marketing and potentially hold this on the balance sheet. And there's risk there. And great thing is company gets to go public, but there are also potentially operational capital requirements that would come into effect here too that would make it so banks want to do less of this or charge more. And finally, this matters in the asset management space. Even just think of a small business that depends on a bank to help them manage their finances and make sure they're not just set up for the short term and medium term, but also making appropriate investments with their cash in the long term as well.
I think some of these almost perverse incentives that the proposal creates are fascinating to consider if the regulators really thought about it. Like coming back to the credit card point, that there are a number of features of the proposal that are likely to lead to banks reducing credit limits for customers of all types, commercial and consumer. And in the commercial space, like you explained, that can be a bad thing. But in the consumer space, it's also a bad thing because what is our credit score based on? The credit score when I pull up the little calculator on my credit card, and one of the driving factors of it is my utilization, the amount of credit I'm utilizing relative to the overall credit I'm entitled to. And one of the rules of thumb I've always heard is try to keep your monthly utilization under 7%, or if it goes above 10%, it can start having a negative effect on your credit score. And so if we're telling banks to cut people's credit limits, that's effectively pushing their utilization up, which will then push their credit scores down. And so again, that's just one of those counterintuitive points to the proposal where it's like, did someone really think through that, say, by disincentivizing banks from offering securities brokerage, we might lead to the reintroduction of trading fees? Right now, like I pay effectively no trading fees on my brokerage account, because it's a little consumer brokerage account. No one really cares about it. But if we went back to having commissions on each trade because that was how the bank felt they needed to offset the op risk capital charge, is that what consumers want?
I don't think so. But great examples just about how this is not just a banking issue. Like if you change the economics of banking and you change the incentive structure, banks are going to have to respond accordingly. And it gets back to the theme I've been trying to hit on throughout this podcast is you're either going to get less of what these banks are offering today, or they're going to have to charge a higher price.
Now, you've thought about this a lot, I can tell, because you guys wrote this report, you've sent letters to Congress and other groups. But for your members out there, for the people who only see the end result of this in the new little insert to their business credit card saying the rate has gone up, what are you doing to educate that part of Main Street business?
Yeah, absolutely. So we're directly engaging with companies in our membership so they're educated on these issues. We want them to understand that their financial options may be more limited or expensive in the coming years. Today, we're launching a nationwide effort to drive public attention to this issue. We're running digital ads in DC and soon in numerous states. We have a page on the Chamber's website, uschamber.com/finance, dedicated to this issue. We're also starting to work with our Federation of State and Local Chambers so business leaders in every community can be more engaged.
Now, one thing I remember, because I very briefly was at the SEC in their risk analytics division. I think it's called DIRA now. You were a legend in their hallways because you had won several court cases against them for improper rulemakings. And they have a very strict economic analysis requirements hard coded into their statutes. And I think that was one of the really, other than maybe the FDA tobacco cases, that was one of the first cases where the courts came so firmly down on an agency saying, you got it wrong. And you need to go back and do your math. So again, you had quite a reputation around there. There was an entire division created in response to remediating the errors that were pointed out through your litigation. I've heard lots of things being thrown around. Are you guys looking at litigation as a response to Endgame?
So appreciate the first of all, appreciate the compliments about our previous legal challenges to financial regulations in the past. And as you mentioned, we have a first-in-class litigation team at the Chamber. Here we effectively have an in-house law firm that sits right next door to me, and they do great work. They have a stellar record in court, and my team at CCMC has partnered with them on numerous issues. So notably, 2 weeks ago, the Fifth Circuit ruled that the SEC had failed to complete an adequate cost-benefit analysis on its stock buyback disclosure rule. Previous lawsuits from the Chamber against the SEC, including on the agency's conflict minerals disclosure rule, set really important precedent for SEC's use of cost-benefit analysis. And there were a number of years in there where the agency had approved its cost-benefit analysis, and we praised it. The SEC, however, did not follow the right process and adhering to those requirements with the stock buyback disclosure rule, in our view, and in the view of the court. So as it relates to the Basel III Endgame proposal, I'll say that we never decide to sue an agency before we see final rule. Never. However, in this case, we've laid out some serious process concerns and made some pretty strong arguments around the need to conduct a robust cost-benefit analysis. And we would expect for those to be addressed by the federal banking regulators throughout the rulemaking process. Otherwise, we'll have to revisit this conversation.
That makes a lot of sense. And I think it's interesting when you look at a document that it's over 1,000 pages long. And for those, you've been doing this even longer, but you know how in those 1,000 pages, there's a great deal of repetition, that there's the rule text, and then there is the summary of the rule text and the summary of the summary. And so when you get down to the actual new content, it's the kind of thing that people like you and me go through and like, oh, here's one sentence that says something I wasn't expecting it to. Like, let me grab onto that. And so while it's 1,100 pages, there isn't actually a lot of new content or new analysis in there. There's a similar long-term debt proposal that's out there right now, and I think it's interesting to contrast that in that long-term debt proposal, there was a 4-page discussion of why the banking regulators set the minimum denominations for long-term debt at $400,000. And they went through their math of looking at the average size of an asset management account, and they had footnotes to different publications, and I was like, oh, this is different. This is way more informative than really anything I'm seeing in the Endgame one. And it was around just 1 point of the long-term debt. And so I really couldn't imagine what, like, we're gonna have some great comments on Endgame, but I couldn't imagine how much better they would be if we had things like that to analyze for all of the parts of Endgame. That would have been maybe have taken away from Christmas for me, but it would have been a nice present.
Yeah. I think this regulations, it's incumbent on the federal regulators in this case and in other cases to justify their rule. We aren't saying no new rules. We aren't saying, no capital increases. We're simply saying, please tell us why and please show us your math so we can have an honest discussion about whether or not this achieves the, optimal level of capital in the banking system.
Great. Well, Bill, I really want to thank you for joining me today. This has been a great conversation, and always appreciate getting a little commercial perspective into the stuffy banking world. I also want to thank our listeners. Without you, we wouldn't have a reason to do this program. And so from us here at Mayor Brown, Incredibly Challenged, thank you and have a great day.